Uh, this behavioral finance. So since morning we are talking about this behavioral finance uh, or behavioral economics. Now the question is, what is behavioral finance? So as our previous speakers have already given a brief introduction about the subject called behavioral finance. So here again it will be a recap of the topic called behavioral finance. So behavioral finance, as it is combination of two words, behavior and finance. So finance will be there plus behavior, and we know that finance is one of the functional areas of management or one of the department in the entire organization. And we also, being a student of commerce or management, we might have studied organizational behavior. So if an organization can have behavior, so it's some of the department like finance, marketing, production, HR or accounting, they also can have a behavior. I'm just trying to have a louder thinking. If an organization can have a behavior, its department can also have a behavior. So finance and behavior. So traditionally finance, when we have been taught about what is finance right in our higher secondary first year to or even in the graduation or in the master degree level, finance is something that which talks about identifying the sources of finance, identifying the sources of fund and its application of fund. So basically it have three functions: finance function, like identifying the sources of funds; investment function, where the funds will be invested; and dividend function. The outcome of this entire organization, entire the business will be the profit and how the profit will be distributed. So this finance. And when we have talked about behavioral finance, it is something more than that. So what is behavior? So uh, when we talk about behavioral finance, it is an intersection of, as our learned keynote speaker have said, that it is finance plus psychology plus sociology and plus something else also that we'll get to know later. But behavioral finance is like study of psychological based theories to understand the behavior of finance or to understand the finances. Now the question is it different from the traditional finance? Since long time we have been studying about the finance, traditional finance. So how it is different from the traditional finance? The answer is yes, it is different from the traditional finance. But the question is how? There are certain assumptions in traditional finance and behavioral finance, and this is how we'll try to understand the difference between the traditional finance and behavioral finance. So the first assumption in traditional finance is that people process data appropriately and correctly. Whatever the theories we have studied in traditional finance, right from the modern portfolio theory of uh, mm, modern portfolio theory, then capital asset pricing model, then uh, arbitrage pricing theory, asset pricing theory, or Modigliani and Miller's dividend theory or valuation theory. So many theories are there. And the one assumption in all the theories, all the finance, is that people process data appropriately and correctly. But behavioral finance, it assumes that people employ imperfect rules of thumb, that is the heuristics, to process data, which includes biases in their belief and predisposes them to commit errors. There is no perfect way of processing data. Everyone will be having their own way of analyzing the data or processing the data based on the person's expertise, based on the person's preconceived notion, based on the person's uh, understanding of the data. Everybody will be processing the data from their own perspective, and it will be based on their belief and the predisposes them to commit error. And because of that, there is no perfect decision, as we have already understand in the previous session, and we are prone to commit errors. People view all decisions through the transparent and objective lens of risk and return, inconsequential frame decision. Traditional finance, it assumes that uh, people view all decisions through the transparent and objective lens of risk and return. But my dear friends, just let me ask you one question. Uh, do you think that only risk and return are the only criteria to evaluate a decision? Or there are some other decisions or some other parameters also to evaluate a decision? There are psychology, there are sociology, anthropology, political science. A person residing in China, he or she may not have the same set of decision frames or same type of decision as a person who is residing in USA. Reason being, a person who is in China, basically it is his or her political system which is commanding or which is dictating what kind of decision that person will be taking, because China is basically a communist economy, USA is basically a capitalist economy, and this communist economy and capitalist economy, both of them have a dictation on what kind of decision people will be taking, the environment. But perception of risk and returns are significantly influenced by how decisions or problems are framed. How problems are framed? Let me tell you a story. There was a king, and in his kingdom, one scholar came, and he was a great astrologer. He said that I can, and normally in all our stories, the kings, they do not have anything to do. They simply just to sit down and just to have some fun. And one of the astrologer came and he said that he's a very learned scholar, learned astrologer, and he can say anything. He can whatever will be the future, he can predict it very correctly. King said, okay, tell me my future. The astrologer said that you will see all of your family members dying in front of you. Then the king gets offended and he said, how can you say that all my family members will die in front of me? Put him in jail. He was put into the jail. His son, that is astrologer's son, he came to know that his father is put into jail for speaking the truth. He again went to the king and said, I'm also an astrologer and I can also say you the future, what the future will be yours, that is very correctly and very predictable. King was very happy and said, yes, tell me my future. He said that you will be the longest surviving person in your entire family. This was the version he has said. What he said? You will be the longest surviving person in your entire family. King was very happy. Yes. Now ask me what you want in return from me. He said, I don't want anything, any materialistic thing from you. Just release my father to whom you have imprisoned the day before. King was very happy and he released his father. And when both of them went out of the court, one person have said, sir, do you understand what he said? King asked, what? Both of them have said the same thing, that you will be the longest surviving person in your family. It means that you will see each of your family members dying in front of you. So this is how the framing effect, how the problems are framed, that have an impact on the decision people make. Both of them, if you just go by the rational paradigm, that both of them have stated the same thing, one and the same thing, that you will be the longest surviving member in your family and you will see each of your family members dying in front of you. Both are exactly the same thing. But how the problems are framed, how the sentences are being presented, it have an impact on the decision people have made. So it's not only the risk and return, but it's the how the problems are framed that have an impact in real life. And here lies the importance of behavioral finance. Traditional finance, it says that people are guided by logic, reason and independent judgment. But my dear friends, you just ask yourself how many times you have been guided by reason, logic and independent judgment. As sir have said that you might have the feel that you are a very logical person, you are a very rational person, but even the rationality is not very logic. It is based on some preconceived notions. Here, most of you are the researchers, and I'm just giving you one example that while testing hypotheses, Normally we set a level of confidence that is 95% and 5% level of significance. And at 5% level of significance or 1% level of significance, we test the hypothesis. We do the test, T test, F test, chi-square test, Z test. So many tests are there. So 1% or 5%. Normally we use 1% or 5% level of significance, and we arrive at certain decision and we infer the decisions. But the question is, why 5%? Why not 4%? Why not 3%? Either we will go for 5% or we will go for 1%. Okay. So why not 2%? Why not 2.5%? Why not 3%? If not 1%, then directly we'll go to 5%. Meaning thereby we remain subjective, though we are trying to remain objective. We are trying to become objective by testing the hypothesis at 1% or 5%, but we are actually subjective, though we are trying to remain objective with this. So that's why people are guided by logic and independent judgment, but actually they are not. And behavioral finance, it says that people are guided by emotions, herd instincts for making any decision. Our emotions, what kind of emotions we have, like just give me one, let me tell you one example. There are two companies in front of you and you have to make an investment. One is, I'm just telling the name of that company, say it is Infosys, and another is a company from China. A company from China is very profitable company. Then Infosys, it is on all the parameters of Infosys, company from China is very profitable. But many of us will not go for investment in a company that is Chinese company, and we will go for investment in Infosys or Tata Consultancy Services or any Indian company. It is because of our emotions. We feel attached to a company which is from India, and we do not want to invest in a company which is not in a very good terms with India. That is, our emotions play a very important role. But our logic say that invest in a company which is very profitable, but our emotions will say that invest in a company which is our company, which belongs to our country. This is just an example. There can be a home site bias, there can be familiarity bias, there can be several biases. So emotions will play a role in making our decision or influencing decisions. So here is the difference between the traditional finance and behavioral finance. Traditional finance, it assumes that markets are efficient. Market prices of each security is an unbiased estimate of its intrinsic value. Now here the term intrinsic value, that the market price of an security is unbiased estimates of intrinsic value. Now what is intrinsic value? The fair value, the true value of a company. But what is the true value of a company? Even the true value of a company, it is not true, or even it is not same all the time. At one point of time it is one thing, at another point of time it is another. In a booming market, its true value will be different. In a bullish market, it's in a bearish market, its intrinsic value will be different. So if you ask any person, a person in the stock market or any player in the market, that is the prices are conforming to the intrinsic value, that person, most of the time that person might say that what is intrinsic value, though theoretically he may arrive at some number, but he or she may not be sure about the intrinsic value. Had it been the case that the person is very much certain about the intrinsic value, there would not have been any fluctuation in the market. There is just so much of the fluctuation in the stock market or any property prices. It means that markets are not efficient, means, and theoretically also it has been established that markets are not efficient in the short run. In the long run, it may be have some efficiency, that too also in the weak form of market efficiency, but in the short run there is no efficiency in the market. And behavioral finance, it assumes that heuristic driven biases, errors, frame dependence, and the effects of emotions and social influence often lead to discrepancy between the market price and fundamental value. Now we'll discuss like heuristic driven biases. Heuristics are the judgmental shortcuts, errors, frame dependence, how the decisions are or the problems are being framed, we have already discussed. Emotions, social influence, like one category say Islamic finance. You might have heard about Islamic finance or the Muslim investors. Muslim investors, they do not want to invest. Actually, their religion is prohibiting them from investing in a company which actually deals with certain prohibited items. Say, for example, if a company is dealing with the interest, if the company is dealing in liquor, if the company is dealing in gambling, then the Sharia, it prohibits them to invest into those companies. That is the Islamic finance. A new domain is coming. So it's a society, it's a social influence. And if you ask a person who is a believer in Sharia, ask him that you invest in a company, this company X is a very profitable company, and he will ask what kind of business this company does. He said this company is actually in the business of production, marketing of alcohols. That person will simply say, no, I will not invest in this company, howsoever profitability is, because it is his social influence which is guiding that person not to invest in that company. So meaning thereby, he is not guided by simply risk and return, but actually his belief, social influence is guiding him to go for certain kinds of investment. So this is how, just in brief, like how this traditional finance and behavioral finance are different. Now, why the need for behavioral finance emerged? We have already studying finance, we have been studying economics since 2500 years. Then why all of a sudden we have discovered that there is a need to study behavioral finance? So we have seen crisis situation, 1929, the Great Depression, then Mexican crisis, 1991 Indian currency crisis, 1997 South Asian, the East Asian currency crisis, 2008 Great Financial Crisis. So many crises. We have so many experts, economical experts, we have finance experts, we have management experts, and interestingly, none of the experts were able to predict the crisis situation. Everybody starts talking about the crisis situation when actually it had happened. But before happening that crisis, nobody was actually trying to predict that, okay, there might be a crisis situation. I remember in 2008, when this great financial crisis has happened, in 2006, early part of 2007, the stock market level was at the Sensex was around 8,000, 8,500. And in early 2008, stock market level have went up to 21,000 level. Now nobody have asked any question like what actually had happened with the Indian companies that within a period of only 6 months our stock market or the market wealth have just become more than double. Does we really produce more than double start producing more than the double within this only 6 months? Whether we started consuming more than twice in the last 6 months, whether our profits of the company we started becoming double in the last only 3, 4, 5 months? Nobody had questioned. Everybody was saying that at that time, everybody was saying that the fundamentals of Indian economy was very strong and market will go up to 25,000, 30,000. And in January 2008, when the market started crashing and it came down to the level of 7,500, from 21,000 to 7,500, it came down. Everybody started saying that the market will go further, market will see more deeper situation than this. Now, when the market was bullish, everybody was predicting that market will go to the 30,000 level, and when the market was bearish, everybody was predicting the market will touch even the level of 5,000, 4,000, 3,000, what not. But nobody was able to predict the market correctly. And remember, we have the experts from all around the globe who are studying finance, who are studying economics. Bankruptcy, Lehman Brothers collapsed in early part of 2008, and I still remember the headline of the Economic Times of India: Lehman collapsed, Harvard behind. This was the headline: Lehman collapsed, Harvard behind. That this Lehman Brothers was headed by the graduates from Harvard University and IIM Ahmedabad and MIT, big institutions where the product of all these big institutions were working in this Lehman Brothers, and still it collapsed. Stock market crash, so many stock market crash we have seen, but the question is, all this crash, bankruptcy or crisis situation were predicted, or this all these theories, economic theories or financial models, they fail to predict or provide solutions to all these situations. And here the question was like, what is the solution? And the solution that the experts have identified, that all these things are, whether it is a crisis situation or market crash or bankruptcy, there are some behavioral aspect. This Lehman collapsed, Harvard behind. So Harvard is not, but the products of Harvard, the students of Harvard are behind. Their psychology, their attitude, their working behavior is behind that. So it's a behavioral finance, which was and the experts, they started identifying the answer to all these things in behavioral finance. And since then, behavioral finance have started getting momentum. Why traditional finance failed? So one thing is that it's unrealistic assumption. And what are those unrealistic assumptions? That participants are rational. What is rational? That we are trying to maximize our benefit at a given level of cost, or we are trying to minimize our cost at a given level of benefit. If we are doing that, it means that we are rational. In the first session, a lot of things have been talked about rationality, so I will not go in that much of the detail. Only thing is that I will explain. So if the market participants are rational or the investors are rational, then the question is, there should not have any fluctuation in the stock market, because if a security X is attractive security for me, I will try to hold it and I will not try to sell it. And if I will not try to sell it, it will be attractive security for another person also who is trying to buy it. But since I know that this is a very attractive security, this is a very profitable company, I will not sell it. And if I will not sell it, other person cannot buy it. I will sell only when I am in need of money. I will not sell on the basis that this security is overpriced or this security is overvalued, or I will not buy a security only on the base assumption that this security is underpriced. Because the participants are rational and everybody have all the informations and everybody are utility maximizers. So if participants would have been rational, there won't be so much of the fluctuation in the stock market. So there are fluctuations in the stock market. This itself is a testimony of the fact that the participants are not rational. Just one example, how rational we are. Just consider the case of India and China. We have been told, or we have been asked by some of the NGOs, the social media, that boycott China. And many of us are boycotting Chinese product, many of us are not. And if we are boycotting Chinese product, does it mean that we are irrational? And definitely none of us would like to be called as irrational. Though we are boycotting Chinese product, it's very cheaper, but at the same time, we do not want ourselves to be called as irrational. So what we are? So we can say that our rationality is biased. We have a biased rationality. This is another terminology which is now being used, that we are not irrational. We are having a biased rationality, and it is a new terminology used in the behavioral finance domain. Similarly, are investors really rational? So this picture actually is presenting the truth that this person is saying the unpleasant truth, but which is unpleasant and comforting lies. And person who is saying the comforting lies, knowingly that this is not correct, everybody is going towards that person only. So this picture itself states that we are not fully rational. Some examples like stock price reaction to non-information. We are saying that we are rational, but crash of 1987, 22.6% decline was without any apparent news. There was no news at all, but market collapsed by 22%. 50 largest one-day stock price movement occurred on the days of no major announcement. Normally we believe that stock prices, stock market reacts to the informations or the announcements. But one studies that 50 largest one-day stock price movement, it has happened on days of no major announcement. Inclusion of a stock in S&P 500 index results in significant share price reaction. A stock is included in S&P 500 or BSE Sensex or BSE 500, BSE 300. Does it going to affect the working of the company? Does it going to affect the management of the company? Suppose a company, say Reliance, it is included in Sensex or it is included in Nifty 50, because we know that Sensex is an average price index of 30 companies. And suppose one company is included in that 30 companies, it's not going to affect the working of that company, whether it's profit, its customers, its consumption pattern, its management, nothing. Only it has been included in one of the index, and the result is that there is a significant rise in the stock prices simply because it has been included. There is no rationality. A rational thinking would have said that since it is already listed in a Bombay Stock Exchange or National Stock Exchange or New York Stock Exchange or London Stock Exchange, and it is simply included in one of the index, is not going to significantly affect the working pattern of the company, but prices changes. Another assumption is that investors, they take care of all the available options. Now, let me give you an example. There is a boy, and actually he wanted to marry. And if you want to marry, so all the girls on the earth in a particular age group are the options. So we know that the total population of the world is 7 billion. Technically, there will be 3.5 billion male and 3.5 billion female. And out of 3.5 billion, suppose 1.5 billion females are in the age category of say 20 to 35, and all these girls who are in the age group of 20 to 30, they are the option for this boy to marry. And if he starts exploring all the options, that before taking any decision he will take care of all the available options, ultimately he will end up not marrying, because his whole life will pass and he will not be able to marry, because to meet 100 or 1.5 crore 150 crore girls, ultimately his life will pass and he will not marry. So ultimately the thing is that investors, they do not take care of all the available options before making any decisions. So they only take care of those options which catch his or her attention, okay, or only the relevant options. There are almost 8,000 number of securities listed in Bombay Stock Exchange, around less than 2,000 number of securities listed in National Stock Exchange. Similarly, thousands and thousands of securities are listed in other stock exchanges all over the world. So there are thousands of securities, and before making a decision to invest in one particular security, we are not going to evaluate pros and cons of all the securities, because if we'll do that, ultimately we will end up investing nothing in any of the securities, because all the securities have some good things and some bad things, and it will take, by the time we will arrive at a decision, the entire market, entire scenario will change. So the fact is that the investors, they do not take care of all the available informations. Like this is a very common scenario that whenever we have to install a software in our computer, we just go for clicking the yes button. Yes, I accept the terms and conditions, and our software is installed. We do not even read what is written, meaning thereby we do not take care of all the available informations. We do not evaluate, we do not read. And the same is true in case of our investment also. We put our signature on certain documents simply because our broker or the agent is asking us to sign at certain places, and we sign, and most of the time we do not even read what is written, and we make investment simply on the recommendation of some of our brokers or agent, that you invest in this company, invest in this product or security, your money will be double or triple, or you'll be getting this much of the return, and we do not ultimately read what is given. So meaning thereby investors, they do not take care of all the available information. So this assumption of traditional finance, it also does not hold good. Another assumption in almost all the traditional finance models are that the markets are perfect, and if the markets are perfect, So there will be certain assumptions like large number of buyers and sellers, homogeneous product, free entry and exit, perfect knowledge of prices and technology, no transportation cost, no restrictions, everything. And being a student of economics, we know that this perfect market, it does not exist in reality. It exists in some limited sense in case of agriculture. It exists. But other than agriculture, it does not exist in reality. So this assumption also, it does not hold good. Another assumption is resources are allocated efficiently. This assumption also, being a student of economics and finance, we know that resources are not allocated efficiently, and this assumption is also not valid assumption. So there are certain theories of traditional finance like efficient market hypothesis, modern portfolio theory, asset pricing models, capital asset pricing model, expected utility theory, dividend theories, valuation theories, and many more. And in almost all the theory, these assumptions are there, and we have also seen that these assumptions that do not hold good, and that's why we have our traditional finance theories. They fail to predict whether it is a situation of crisis or market crash or bankruptcy or any other emergency situation. They are not able to predict, or with the existing setup they are not able to predict efficiently, and that's why we need some help, we need some support from some other domain, maybe psychological domain, sociological domain. We need to understand anthropology, we need to understand sociology, and that's why we have this behavioral finance. Another interesting thing, most of the theories in traditional finance, if you just divide the human being based on the rationality or irrational, or rational behavior or irrational behavior, we have four situations, four possible situations. Rational man, and when I'm uttering the word man, women, please do not get offended. When I'm uttering the word man, I do not mean that women should be excluded. This is just writing, and next time I will correct it. So rational man making rational decision, rational man making irrational decision, irrational man making irrational decision, and irrational man making irrational decision. These are four decision situations available. And interestingly, our traditional finance theories, they only have the answer to the rational man making a rational decision, because rationality is the key word in almost all the theories. Means rational person making a rational decision, these are only studied in traditional finance. It means that if a person is rational but making irrational decision, or irrational person, or now I need to correct myself that even person is not irrational, but his or her rationality is biased. So a person with biased rationality making irrational decision, or person with biased rationality making rational decision, all these other three quadrants are not studied. Means actually we are not studying 3/4 of the total decision situations available in our domain. We are only studying 25% of the situations, and that too which are not actually happening. So here lies the significance of studying behavioral finance. Then there are some models of human being which is being evolved of late in the study of finance and behavioral finance. Traditionally, the traditional finance, they assume that rational human being, that human being will be rational. What is rational? We have already studied. So this is the traditional finance view, the rational human being. Later on, it has been said irrational or human being with emotionals. That is the model of human being. It was early development in the behavioral finance, that irrational human being or emotional human being. This is the early development that Bawal sir was referring to, like right from the 1960s. This development or research in the behavioral finance started. So from 1960 to maybe the early 2000, this was the model that irrational or emotional human being will be there. So early development in behavioral finance. And then biased rationality. Rationality, human being will not be irrational. It will be wrong to call human being as irrational, but the rationality of that person is biased. That is the later development in behavioral finance, that is early 2000. And Later on, Professor Stateman, who is also an authority in the area of behavioral finance, he had coined a term that human being is a normal human being. Don't bracket him in the rational or irrational or biased rational human being. He's a normal human being. And when we have a normal human being, he will have all the emotions. Sometimes he will be happy, sometimes he will be greedy, sometimes he will be fearful, sometimes he will be sad. A normal human being, and he will have all the emotions of a normal human being. And having all those emotions, the normal human being will be making his or her decision. So this is a recent model of human being in behavioral finance. So this is how the model of human being in behavioral finance have evolved. So finally, we can say that the premise of behavioral finance states that by considering psychological factors into account, the effectiveness of investment strategies can be enhanced. And behavioral finance is a branch of study that uses psychology-based theories to explain market anomalies. And the psychology is already there. Sociology we have already discussed, like the sociology of a person, what kind of social culture or background that person is having, it influences a person to go for what kind of investment, what kind of financial practices that person will be practicing. Anthropology, where natural science, the evolution of human being have an impact on the person's behavioral aspect, financial aspect. There is anthropology, like the history of that person. History is very important. Economics, one thing I have left, it's political science. A person who is residing in China, a person residing in Russia, a person in India and USA, all the four persons have four types of behavioral pattern, and it is because of the political system in place in all these four countries. India is having mixed economic system, so if you want to invest, I can invest in a public sector company, I can invest in a private sector company, but in USA, most of the companies will be private sector company. In earlier USSR or Russia, most of the companies will be public sector companies, and there will be restrictions on investment also, what kind of investment we'll be making. So accounting also have, management practices also have an impact. So behavioral finance is a sum total of psychology, sociology, anthropology, economics, political science, accounting, and all these domains have a collective influence on behavioral finance. As sir have already, while referring to some of the papers, you must have seen that sometimes it was the political science, sometimes it's anthropology, sometimes it's the accounting, sometimes sociology. So now behavioral finance is such an area that almost all the theories from different areas are now contributing towards the development of behavioral finance, and it is in a very early phase. Maybe 20 years down the line we'll be able to see this discipline in a very much mature way. Now, history of behavioral finance study, when it had started. So when we discussed about this economics, we know that there are classical economics are there. During the classical period, economics was having a very close link with sociology. If you go through some of the writings of, say, Adam Smith or these classical authors of during that time, we'll find that economics is having very close linkage with this psychology. But gradually, during this neoclassical period and in the early 20th century, psychology has largely started to be disappeared from the economic discussions. And it is basically because during the neoclassical period, many economists, they arrived and they started to make themselves distant from the psychology, on the belief that we are economists, we have to be very rational. We should not be influenced by the emotions. We should not be guided by any sociological background of the person. We have to be rational, and that's why they started to get distance themselves from this sociology and psychology. And ultimately, what left in the earlier 20th century was the pure form of economics, having only rational human being making rational decision. There is no scope for emotions. There is no scope for psychology. That was the assumption. That was the development in the 20th century. So this is the history of behavioral finance study, how psychology started to be disappearing from this economic discussion. In India, Kautilya, he wrote Arthashastra in 300 BC. And if any one of us who have understand Arthashastra or gone through the Arthashastra, Arthashastra means economics. Arthashastra is a Sanskrit word which means economics. So Kautilya, when in the West have started studying economics, maybe only from the 15th and 16th century. In India, we have the study of economics from 300 BC. Just a minute, one important phone is coming. Hello, sir. सेशन नहीं है वो कितना का नंबर चढ़ा है हाँ ठीक ठीक ओके okay, so in India we had a full-fledged book on economics 300 BC, and what is there in that book? It is not purely economics. It's a close knit of political science, public administration, and economics. Because when dealing with the economics, it also have writings on what kind, how the public administration be, what kind of political science, economics have an impact on political science. So it is not pure economics. It is something political science, public administration, economics, some mix of sociology is there, psychology is there, everything. So meaning thereby this behavioral finance is not a very new thing. It was already there in our classical period, but in the modern period it has started disappearing. And then again from 1960, that is the late 20th century, this discourse started that why not to mix this sociology and psychology with the economics, so that the efficiency of the economic decisions or finance decisions can be enhanced. And people have started, as we have already seen with a lot of papers in the keynote address. So during this early 19th century to the 20th century, economics, political science, psychology, and all these disciplines were started to be divided. Sectoral border where there decision by discipline, decision A by discipline A, decision B by discipline B. This decision started happening. Economics also started to be divided into commerce, management, economics, and so on and so forth. So much of the division was started in due course of time. So mixing of psychology with economics, as we have seen that in the late 20th century, this has started, but the most important development in the mixing of psychology with economics was done by this person, Daniel Kahneman. Okay, he is the propounder of prospect theory, and he got the Nobel Prize of Economics in 2002. So basically he is a psychologist, and in 2002 a significant development happened that the Nobel Prize of Economics was given to a psychologist. Another person, Richard Thaler, he is known for the evolution of nudge theory. The next session is on nudge theory only. So evolution of nudge theory is there, and he got the Nobel Prize of Economics in 2017. So the discipline of behavioral finance have got, there are others also, but two pure behavioral economists who got Nobel Prize within a time period of 20 years alone. So this itself is highlighting the importance of the discipline called behavioral finance. In 2002 to 2017, within a period of 15 years, we got two Nobel laureates. Now, there are some criticisms of behavioral finance. One group of economists say that this is simply a collection of anomalies. True, it is a collection of anomalies. But my dear friends, you must be understanding that any new development, any new discipline, it starts with the observation of anomalies only. That there are certain anomalies which the existing theories are not able to answer, and that's why these anomalies are tried to be understood And this is how a new domain of behavioral finance is emerging. Like our HOD sir was referring to the January effect, or the days of the week effect, or January full moon effect, or the lunar effect. All these effects are there. So many anomalies are there. All these anomalies will be studied using this behavioral finance, psychology, and sociology. And once these anomalies are understood, this will be a new development, new discipline. This is inapplicable to the market situation. This is another allegation on behavioral finance. But even traditional finance theories are not able to predict the market. And if even the traditional finance theories are not able to predict the market, behavioral finance is actually in a kind of help to the traditional finance people, so that they can make the market predictability, or they try to predict the market situations more correctly, more accurately. So this allegation also, it does not hold good. Limitations of experimental and survey based technique. Just now sir have said that in physics, in laboratory equal to mc square was established long back in 1921 itself, but it was empirically tested only using this experimental and survey based research. So this, we have most of our researches in the form of experimental research or survey based research. This is not our limitation, this is our strength. And another thing is that all the disciplines have different methods of research. Some of the disciplines, they focus more on the experimental research. Some of the discipline, they focus more on the laboratory research. Some of the discipline, they focus more on the naturalistic observation. So all the disciplines have their own areas and their own strength. Behavioral finance is focusing more on the experimental and survey based technique. What's wrong with that? It is actually, we can say that is a much more enhanced way of doing research than the traditional one. And many times limitations are not in the method, but due to not following the methods appropriately. And we have weak empirical evidence. Now, behavioral finance is just a newborn child, and we are trying to compare this newborn child with a very much more mature person. So this comparison is also not true, that it has a weak empirical evidence. It is a newborn child, and it will take time, maybe 20 years, as I told, 20 years or 30 years or 50 years down the line. We do not have this weak empirical evidence. Instead of weak empirical evidence, we have very sound empirical evidence. Too much emphasis on investor irrationality. So too much emphasis on investor irrationality is there, correct? But individual irrationality was the earlier assumption. Now the focus is on biased rationality, and a lot of researches are still going on. Still it is in the development phase. Maybe in the time to come, it will say some much more mature content on behavioral finance, also more weightage on the attitude than on investment system. But this is also those who have invested in the stock market, or those who are doing research in the stock market, you know that most of the investors, they do not follow any very systematic investment system, investment guideline. Rather, they just go by the gut feeling that this investment will be good, this investment will not be so good. So they just go by the gut feeling. And recently one web series was telecasted on Sony Live, that is a Scam 1992. And if you just go through that story and have gone through the story of Arshad Mehta, risk hai to isk hai, it is just the attitude of that person which makes the difference. It was the same market, it was the same procedures, same systems, investment guidelines were there, but he has started looking all those things from a different perspective. Means it was his attitude which have changed the entire scenario, and we have seen such a big story. Though it is, people call it a scam, but it was actually opening of the door of Indian stock market for the new heights. It has shown that and most of the loopholes which were there in the system, actually it has started. He has highlighted all those loopholes in the 1992 itself. So attitude is more important than in investment system. There are some arguments in favor of behavioral finance, that absence of behavioral CAPM is there. behavioral CAPM. Later on, pharma came up with a behavioral CAPM. He came up that model. And validity of efficient market hypothesis and investor rationality is questionable. We have already discussed. And investors make systematic mental mistakes. We have already discussed. There are certain theories in behavioral finance. There is no specific theory in behavioral finance. Theories from other disciplines such as psychology, anthropology, economics are there, and we are trying to just translate all those theories in the context of finance and behavioral finance. So it is still evolving. Some of the theories are like prospect theory, nudge theory, regret theory, anchoring, disposition effect, mental accounting, overreaction, overconfidence, gambler's fallacy, herd behavior, and so many investment biases are there. All these things are there. So we already have a session on prospect theory. We will be discussing about nudge theory, regret theory, mental accounting. Will be discussing overreaction, overconfidence, hard behavior. All these things will be discussed by the respective resource person and their respective technical sessions, and some other theories also which is not mentioned in this list. So it will be discussed in this entire 5-day session, summer school on behavioral finance. So that's all about the introduction of the area called behavioral finance. So thank you. If you have any question, please feel free to ask.